So a couple months ago, raised my S&P target to 7,500, my NASDAQ target from 24 to 25,000, and I left my Dow target at 55,000, my Russell target at 3,300. So if you do the math on any of those, basically, I still think you've got 40% upside in the Russell, probably something like 25 to 30% upside in the other averages. So to me, there's a long runway still ahead.
So on this episode of What the Finance podcast, I have the pleasure of welcoming back very well-known guest, one of our most popular, David Hunter. So David is a contrarian macro strategist with over 50 years of experience on Wall Street. So David, thanks so much for coming on the podcast today.
Yeah, hi Anthony, great to see you again.
Yeah, great seeing you too. And I think I mentioned this last time as well, but the first time we spoke was October, the 6th of October in 2022.
Really?
Yeah, which is a few years, more than 2 years ago, which is crazy. But at that time, you said that the S&P had bottomed and would drive up to 6,000. I think a lot of people thought you were crazy. Many people questioned it, but I think the S&P bottomed a week later, and then since then it's gone up over 75%, and we've recently passed the 6,000 mark. So I just wanted to say, congratulations! It's an amazing call, and I think it's showing that you've got on the right again. So, yeah,
It
it's
took a
amazing to
while for
see.
people to believe it, but you're obviously seeing people come over to that side now. For a long time I had to take the abuse of people thinking I was just nuts, but yeah, I mean that was the bottom, and I think we still got a pretty good runway ahead of us.
Yeah, so that was what I was going to ask. So, hit the 6,000. I think last time you were mentioning, 6.5, potentially seven. Is that still what you're thinking, or are you thinking even further up? What is your current thoughts?
Yeah, I actually raised my targets in my September letter, which my October letter, my fourth quarter letter. So a couple months ago, raised my S&P target to 7,500, my NASDAQ target from 24 to 25,000, and I left my Dow target at 55,000, my Russell target at 3,300. So if you do the math on any of those, basically, I still think you've got 40% upside in the Russell, probably something like 25 to 30% upside in the other averages. So to me, there's a long runway still ahead. Everybody wants to know timing on it, and I do think it's going to get steeper here. So it could be a top in the first quarter for sure, but if it goes a little beyond that, it's not going to be a surprise, because when I look at my work and I look at a lot of cross market stuff, there's so many sectors that have plenty of upside from here. So if anything, I think my numbers are going to prove conservative.
Okay. And what are you looking at? Because I think a lot of people hear the numbers, but I'm sure they'd be interested to see what you're looking at
Yeah,
for this.
sure. As I say, I use technicals to some extent. I use fundamentals. Obviously, my strength is my macro, so that goes into it. And then what I call cross markets is basically looking at other bond markets, currencies, other stock markets, and as well as sectors within. And so a lot of the cross market stuff for me is, if the sectors underneath the averages are suggesting something that confirms what I see in the averages, that helps me a lot. So, it's all of that. And then, of course, sentiment. And, if I saw everybody, certainly there's a lot more bulls today than there were a year ago, but if I saw, or even 6 months ago, but if I saw everybody, talking about the super bullish market, I'd be more concerned. What I see right now is people obviously raising numbers because they're behind and they got to catch up, and they're getting on what I call the bull bandwagon. And they're giving you, we're in the season where you get end of 2025 targets. I don't do year end targets, but a lot of people do on Wall Street. And if you look at it, people go, well, they're coming up with your numbers. 7,000 I saw today from somebody on the street, pretty well known strategist. And they go, is he copying you? I go, no. Basically, if you do the numbers from here, that's 15%. So he's obviously getting more bullish, and he's saying a 15% upside from here seems reasonable. So that's what you're getting. And part of that is because the Fed is now beginning an easing cycle that probably has a long ways to go. And interest rates have finally started to roll back over after backing up. So you got a lot of things going for you right now that, as somebody on the street that's trying to do this for a living, call markets. You got wind at your back to some extent. They're not crazy bullish. It's a reasonable, for most of them, I think it's a reasonable judgment at this point to say, yeah, I think the market can go up another 500 to 1,000 points. And of course, I'm beyond that, but I think this is, as I say, I called it 2 years ago, not just the market, but I said when we get closer to the top, you'll see a lot of people sounding like me. It'll be, for a long time, I was a lonely bull. As you get closer to the top, everybody's going to be, getting more and more bullish.
Yeah, and we're getting there, but I don't think we're there yet. As you said, there's a lot of people say there's lots of money on the side that's sort of been waiting for this pullback. There's still trillions of dollars that hasn't invested yet. So, with yields coming down, yeah,
there's 6 or 7 trillion in money market. Just understand that probably 4 or 5 of that trillion is not destined for the stock market. It's people's rainy day money. It's it's a lot of things. So, but I do think you could see certainly a trillion or 2 trillion of that money come off the sidelines and go into the market as we get closer to the top. And that's what people need to understand. I'm a true blue contrarian, so I make my living on understanding this. But at tops, everybody will be all in. At bottoms, everybody's bearish. So you try to reverse that if you want to be a money manager. Is you got to figure out that time when you think people are ebullient and all in, and that's probably the time to start going the other way.
Yeah, but still a bit of time to go until that's the case. And I guess from your perspective, what you mentioned there that there's sort of the Trump trade has been very successful, and it's sort of been has encouraged people to go fully or more into risk on. And a lot of people have been talking about that. So do you see that as being a sort of a bit of a catalyst to this continued extension to the run, or do you think it's what are your thoughts on it?
Yeah, basically, you see, basically from the election day, November 4th, this market's been strong. And I think it was looking at the Trump policies, which are more pro-capitalist, more pro-market. It's a recognition that we're going to get away from a lot of the policies like open borders and things that seem to be hurting this country. So I think you're going to see deregulation, you're going to see tax cuts, you're going to see just across the board. You can see that the policies are going to be 180 degrees from what we've had the last 4 years, and generally are good for the economy and therefore good for the market. Some people will quibble with, and you had some of this for certainly the last couple of months, is people talking about that Trump's policies are going to add to the more to the deficit than his counterpart would have done, and that it's you're going to end up with real problems with debt and deficits. And I would argue that it's a lack of understanding of how supply side economics actually does work, really going all the way back to the years Reagan cut taxes. The left and frankly most academics want to poo-poo tax cuts as raising revenue, but if you look at the history, when we've had big tax cuts, which means marginal tax rates get cut, not taxes don't get cut, the marginal tax rate gets cut. And people want to look at a static model to say if you cut tax rates, you're going to get less revenue. No, because tax rate cuts lead to more activity, lead to a stronger economy, lead to more capital gains, and therefore your revenues go up. It's like a retail store or retail chain saying we want more volume, so we're going to cut prices. You cut and then you get higher volume out of that. So it's a mistaken belief, and most of Wall Street has bought into it too, that supply side cuts do not generate more revenue; they generate less revenue. And what you really have found, in again looking at the evidence, is that our deficits are growing because of a spending problem, not a tax cut problem. So if we get Ramaswamy and Musk coming in, actually taking $1 trillion or $2 out of the government, and if we get kind of knock down some of this waste and fraud, you actually can see that government spending is going to be going down in spite of some of these aggressive programs. And at the same time, the tax revenues are going to be going up, even though tax rates are being cut. And so that's, I think, the bond market backed up on that fear that, gee, Trump is going to, spend us into more problems, and, tax cuts are going to lead to less revenue and bigger deficits. And so we had that backup from 360, I think, to 450 on the 10-year, mostly on the basis of Trump policies. And I think you're seeing now that that correction has run its course. A little bit of the rhetoric is moving back the other way and beginning to not get so worried about growing debt and deficits, because I think we're going to be positively positively surprised in terms of what his policies do bring. Now, that being said, I'm calling for a global bust, as you know, and a global bust is going to be met, because a global bust is something bigger than anything we've seen in post-World War II era in terms of a downturn and financial crisis. The response to that is very predictable. It will be more money printing than we've had in history. So more than 2008-9, more than 2020, which means that I'm saying you could see 20 trillion out of the Fed, and proportionally similar out of every central bank, because they'll be dealing with a free-falling financial system. That when that happens, and it'll be matched, I think, with a similar type fiscal response, so that you're going to have massive spending, massive money. And so take Trump out of the equation and just look at that, and it's going to be very hard to argue that 3, 4, 5 years out, we're not going to have higher inflation, higher deficits, higher debt, all of that, in spite of what Trump, I think, will be delivering. So, but it would have happened under any president. I don't view that as part of the policy. I view that as kind of the predictable response to a bust that's going to come as a result of decades, and I mean many decades, of overspending, poor policy, overborrowing, particularly overborrowing. Leverage in the system, both public and private, is off the rails. I mean, it's so much higher than anything we've seen before, including 2008-9, and that's why I think we get a global bust.
Okay, great. Yeah, that makes a lot of sense. So I think there's been a lot of talk of tariffs as well, and sort of not something that you really touched on there. But I was talking to someone recently, and they were saying that tariffs, they see it as a revenue raising mechanism, which is to offset the tax cuts. But I didn't really agree with that. What is your perspective on tariffs, and whether it's a negotiating ploy?
Well, some of it's a negotiating ploy for sure. I mean, if the art of the deal, we know who Trump is. He always starts with the most aggressive negotiation. He's going to be showing his strongest hand, and then there's room for compromise. If you start with a weakest proposal, you can only go down from there. So he starts with these pretty dramatic announcements, but they're for negotiation. I don't think you'll see tariffs to the extent that the fears are out there. They do raise revenues. The offset is that you do. It's going to be costly to companies. It's going to be costly, obviously, to our trading partners, et cetera. So there is an offset or a negative ramification. However, we are, and I think it's what the next cycle is going to be all about. We are looking to bring back to our shores a lot of the business that we lost, a lot of the industrial output that went to China and went overseas is basically the platform they ran on is bringing back industrial America, restoring blue collar jobs, restoring, some of those higher paying jobs that, particularly the Midwest suffered, Detroit and Chicago and Cleveland, et cetera, or the industry that we lost because of globalist policies. That is coming back. So we're going to see a lot of new factory, new capital spending here and bringing back capacity here that we were, dependent on China for. So tariffs are a necessary part of that. I mean, and it can be costly, but if that's your goal anyway, is to bring that back. The problem is it doesn't happen overnight. You can't, those factories, it takes time to build. So in the meantime, higher cost imports does create a problem. Now, where I think people are maybe wrong, or at least overstating it, is they say tariffs are inflationary. They're inflationary initially, but ultimately, unless you monetize that, I do think, the bus is going to lead to monetization of the debt. But unless you monetize that, it's not an ongoing inflation. You get higher prices, you get lower purchases. People back off. There's going to be some give and take on that. So it's not, unfortunately, too many of the econometric models are static models, or don't do a good job of the offsets. So I think we just have to kind of tone down the expectations there and not be so dire. I think it's kind of let it play out. I think you're gonna be surprised it's not as dramatic as everybody thinks.
Yeah, no, that's a great point, and I guess that's why you see the Russell 2000 potentially performing as well, because of this. Is going to benefit sort of those type of companies as well as decreasing interest rates, or are there other more things behind
certainly that? Lower rates is a part of it, and certainly Trump policies are pro-U.S., which small cap tends to be more U.S. centric. So it's some of that. And I just think it's where we are in the cycle too, that the small cap stocks, which have lagged for a long time, are getting that catch up. And at least for right now, it looks like the economy is on pretty firm ground. So people are, for the longest time from 2022 until recently, people were just thinking the other shoe was going to drop on the economy. Rightly or wrongly, I think you're seeing people start to walk away from that and realize, or at least think, that there's a longer economic runway ahead, that it's not, recession's not imminent, that the economy may actually strengthen, not weaken. I'm not saying that's a correct analysis, but I think that's the thinking on the street right now, or at least that's where we're moving to. I think that'll be part of the run to the top. Is there'll be this narrative that the economy's on sound footing or relatively strong. Inflation's coming down, interest rates are coming down, the dollar is weakening, and that with the Fed starting to ease, just started in September, that easing cycle probably has a couple of years to run, and therefore the cycle has a couple of years to run, at least maybe 2 or 3. Again, that's not my view, but that's what I think the narrative will be that will take us to the top.
Okay, and then you see, I guess, because the dollar's been extremely strong, and it has been an everything bubble with everything going up as well as the dollar. Do you see sort of that trend continuing despite the interest rate cuts, or do you think there has to be a bit of a
no?
pullback
I
from
think
that?
I think the dollar counter trend run. It got down to about 100 and has run up to 107 and change. I think that run is over. I think the next step down is probably into the low hundreds again, and then ultimately down. My target for the US dollar pre-bust. So I don't know when the bust is going to hit. I think it hits sometime next year, whether it's second quarter or third quarter, I don't know. But pre-bust, and dollar could weaken into the bust. I'm looking for 82 on the dollar. So if DXY, so DXY, currently with 107 or thereabouts, that's a heck of a drop. And some of it will be Trump policies, but some of it is just we had a counter trend rally. Don't forget the dollar fell from 115 to 100, and we just basically did a 50% retracement of that move in the last year. And I think we're about to roll over and heads south of 100 on our way to 82.
Okay, and that links to why you think you're saying before we sort of started recording that you think precious metals is sort of bottomed and then it could sort of push up from there. So that, I guess that goes into your thinking behind that as well.
Yeah, lower interest rates, lower dollar are going to be big catalyst for what I think is going to be a very big metals rally. Obviously, gold's had a great run, but I have raised my target since we last talked anyway. I think I raised it in the summer, but my gold target's now 3,400, had been 3,000. And again, that's what I call pre-bust, basically. And silver, my target is 75. So, we're a long ways from there now. I think the first half of next year, whether most of it happens in the first quarter or how much of it happens in the second quarter, I don't know. But I think basically first half of next year, you're going to see gold and silver have great runs, and gold's had some sponsorship, but silver's really disappointing people for a long time. So there's a lot of frustrated investors out there that don't want to go near it. As the momentum picks up, I think the next run in silver, I think silver basically had its turn yesterday. I think we basically had the correction bottom yesterday or the day before. And I think silver can next probably run up into the mid 40s, 43, 44. And from there, probably work its way up through the old highs at 48. And then once it breaks out, I think you have another big sprint to 75. The miners, which have lagged even the metals by a lot, the miners have been really a frustrating trade. Again, they look like they turned yesterday, and I suspect we're going to see a strong balance of this year and a strong first quarter for them as well.
Okay, that makes a lot of sense. I was talking to Julian Brigden recently, who's a sort of a quite bullish on precious metals, but he thinks that there has to be sort of blood in the streets, almost like a crash, for it to outperform at least the metals itself. Do you agree with that, or do you think that it's going to follow everything else?
Yeah, I don't agree with that at all. I have heard that around the street a lot. And I don't know if he's a technician, but I see this a lot with technicians. Is they're always looking for that perfect entry point. They see a trend line or a level down there where they think it's starting to move in that direction, and that's the perfect place where it can turn. And I can't tell you how many times in my career I've watched those people have people waiting on the sideline for that perfect entry, and it doesn't get there, and they keep waiting, and then when they finally capitulate, it's much higher. So I just caution people. I can't tell you precisely that I know that it bottomed, but I think there's a good chance that we saw the correction bottom yesterday, and I don't think you're going to have there's a lot of blood on the streets already in these miners. There's a lot of people that are really frustrated with the miners. So the sentiment is already down there. Gold's done somewhat better because the metals done. Gold miners done somewhat better because the metals done better. But frankly, I think we're very close to big runs in gold, silver, the miners, copper. Materials in general, I think will do very well in this last run to the top of the equity market.
Yeah, okay, that makes sense. And what are your thoughts on crypto? Because I guess Bitcoin has been a major trend, is sort of close to 100,000. Other cryptos have gone up as well. Do you have any thoughts that they're going to continue to rise in line with, I guess, the other markets?
Yeah, I mean, I've said since I've been on Twitter, since crypto's been a story 5 years or whatever. I just don't follow it. I don't, people may disagree with me, but I don't think it's a significant to macro. It doesn't have any macro significance at this point. People take offense to that. It's not a commentary on what its future is. It's just saying, I don't need to follow macro. I mean, I don't need to follow crypto to know what my macro forecast is. It wouldn't change it a bit. So it's great for those that are in it. Again, people misunderstand what a macro strategist is. I'm not out there trying to be in everything that makes money. I'm about forecasting the macro elements. And there's lots of things I'm not in. I'm not in uranium. I'm not in platinum. I'm not in plutonium. I'm not in any of those things. So, or palladium. I choose right now to say crypto, and particularly Bitcoin, is still early. It's still in its infancy relatively. It's not something you can go back and look at a 20, 30, 40, 50-year history. I would like to see how crypto, and particularly Bitcoin, comes through the bust. And if it comes through there, shows its strength, maybe I'll follow it. But I'm not even, it's not even on my radar right now in terms of saying I'm going to follow or not going to, or that I think it's a big deal that I'm not. People think I just missed the move. No, I'm not making a call one way or the other as to whether I think it's attractive or not. I just don't think it's been tested in the ways it needs to be tested. I am concerned some that it has a lot of the characteristics of a speculative market. It's being hyped. A lot of the people surrounding it are people that failed as equity hypers, that used to call equity markets and failed. They ran to crypto, and now they have a huge story surrounding that. I get the attraction. It takes you outside of the central banking system. It gets you outside, government control. I get that, and I get the supply and demand story, particularly on Bitcoin. And that it does have an attraction in terms of being able to be outside the control of our central bankers and stuff. So I get all that. I just, right now, it does not have macro significance, and so I don't feel the need to follow it.
Okay. Yeah, no, that makes a lot of sense. I guess from a market cap perspective, it's still quite small compared to other assets. You've mentioned sort of gold miners. You mentioned, I guess, small caps. You think sort of maybe going to outperform. Is there anything else that you think currently is unloved and that you're watching?
Yeah, one that I was, probably the lead person on it for 3 or 4 years is semiconductor. I talked about it every interview I had, every letter I wrote. I always said semis will lead, and they did. They've had, for the last whatever many months, they've had this consolidation, and people have really gotten turned off to them. I have people asking me questions about them every day. How can you be bullish on semis now? Don't you see that they're breaking down? They're not performing as well as the averages. I said they're in their consolidation that I think has just about run its course. I have a target on SMH, the semi ETF, of 400, and I'm very comfortable with that target. So, where are we now? 250 maybe, or 240 something. Might be over 250 now, but that's basically 60% from here. I think is probably what the upside is. And I look at a lot of individual semiconductor stocks within that. And again, I'm very comfortable saying semis will be one of the big leaders in this final run to the top. I like industrials. I like materials, as I said before. The miners, of course. I think financials, and I was early on in financials when they're lagging. Now they've had a nice catch-up rally, but I think financials still look great. So I think there's quite a bit of upside there. Home builders, housing peaked over a year ago. And what you're seeing, is when rates come down, you get a bounce. So if mortgage rates, I'm expecting the 10-year to get to 3% in the next few months, maybe 2.5 even. So you might get the mortgage rate back down to 5%, let's say. That will stimulate some people who have been on the sidelines because it got too expensive to buy. That may stimulate some activity. So, between now and the spring, you could have a bounce, but you're not getting back to the kind of furious activity you had a year or a year and a half ago. And I saw something today where Florida's had this big inventories coming out of the woodwork there. You're starting to see a lot of Airbnb people who are being forced to sell because they can't carry their mortgage. They thought they had this business plan where they had all the revenues coming in to cover their mortgage. The revenue's not coming in, so they and the mortgage rates are high, so they can't refinance, they can't do anything. They're trying to sell. So there's a lot of inventory in Florida and in Texas for other reasons is rolling over. Some other areas of the country may be firmer, but ultimately I think housing has peaked. And like I said a while ago, and I think in the bust, housing could drop 30, maybe even 40% from peak. So there's, to me, home builders, on the other hand, the home builders have been able to buy down mortgages. Therefore, they've kind of been the game in town. The people could get a better deal by going to a home builder and buying a new house than in the secondary market where they had to get a 7% mortgage. So the mortgage buy down has really helped the home builders, and that's continuing. So I think, again, the home builders could still see pretty good performance here into the top. But again, the next cycle is not going to be kind to the home builder business because first of all, we're going to find there's a lot more inventory once people have now begun to realize that prices aren't just going to go in one straight line up. Now you're starting to see those people that may have held off selling saying, well, I better sell now and it may be too late. They may not have the buyers now to sell. And I think in the bust, you'll see people who will be forced to sell and not have buyers on the other side. So prices have to give. And then the next cycle, which will be a big inflation cycle because of that big money print I talked about, that by the time we get to the last few years of this decade, you'll be looking at double-digit mortgage rates, maybe as high as 15 or 20% mortgage rates. That'll kill housing prices. So, in the short run, I think home builders can still play. Longer term, I'm not sure that next cycle is going to look like this cycle at all.
Yeah, great. Thanks for running us through that. So, David, thanks so much for your time today. Really appreciate it. We've gone in so many different areas, and yeah, interesting to see. I'm looking forward to having you on in 6 months' time and seeing S&P hitting 7,500, and then we'll see if you have to raise your price target again.
Yeah, that's always a possibility that it
yeah.
goes beyond that. I think we're getting closer to that. I think we're in what I call the parabolic stage, which the melt up stage really has been the last year plus, from October of 23, I guess, when we had that secondary correction after the first move out of the 22 bottom. I think we've been in the melt up for the last year plus. And I think we're now in what I would call the steeper parabolic move. Doesn't mean it goes up every day, but it does mean that the slope, when we look back, basically from the August lows when we had the Japanese carry trade, the yen carry trade reversal, maybe that was the start of the parabolic, or certainly the November 4th election turn when we had a 5% move in the market that week. Those two, I think that's basically the start of the parabolic, and I think we just steepen right into a top now. So that means you could cover a lot of ground in a month or 2 or 3. It's hard to know exactly where the top will be, and in that parabolic, it can, maybe it tops at my 7,500. Maybe it blows right through that and it's 88,000 or more. Who knows? But I think time-wise, we're getting very close. Distance-wise, we got a ways to go.
Yep. Okay. Makes sense. But yeah, what is one message? Is that the message you want people to take away? Is there another message you want people to take away from our conversation?
The only other message I would have is following up on what I just said about it being close time wise, is I'm hearing a lot of people wanting to exit here, saying, well, yes, it can go higher, but I'm getting out. I just want them to understand that even if we're within a few months of a top, if that top is going to be 30 or 40% from here and maybe higher, maybe more, because it's a blow off, because it's a parabolic, you might get out here thinking you're comfortable with it. You say, I know I'm going to leave some on the table, but you may not realize how much pressure will be on you at the top, because there's no way at the top of knowing that's top. At the top, there's going to be an awful lot of bullishness out there telling you how this thing can go for another 2 years, or how 10,000 is the target. Not, that's not going to be me, but there's going to be a bullish scenario out there that is going to be hard to fight. So the only thing I tell people is just know yourself. If you can resist all that, then you make your call as to when you want to get out, how much you want to leave on the table. However, if you're the typical probably 80%, 80 or 90% of the investors out there, psychology drives you, whether you know it or not. And that means when you're going to be most nervous being out, when everybody's bullish. For me, it's easy. When everybody's bullish, I'm comfortable being bearish. When everybody's bearish, I'm comfortable with being bullish. Most people are not like that. Most people want to be with the crowd, even if they say they're not people that want to be with the crowd. That's just general investor psychology. That's the way it works. So kind of know yourself is really the story. Know your personality, know how comfortable you are going against the crowd. And if you're not somebody who can go against the crowd comfortably, you might want to just let this ride for a little while.
Yep, great message. So, David, thanks again. So if anyone wanted to find out more about your work, I know you're on X, you have a massive following. You also have a newsletter, which I believe they just have to message you on X and you can give them access. Hey, everyone. Thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that, but it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right. Thanks again.